Welcome to Furniture Industry News. Today is Friday, June 12, 2026, and thanks for spending a few minutes with us. There's a lot moving this week, so let's get right into it. The biggest story is one of the most recognizable names in bedding. Sleep Number has filed for Chapter 11 bankruptcy protection, and at the same time, it has agreed to combine with Sleep Country Canada. This is a 40-year-old brand with more than 570 stores, and its leaders are describing the deal as the foundation of a leading North American mattress and bedding business. Here's how it works. Sleep Country Canada will act as what's called the stalking horse, or lead, bidder in a court-supervised sale. That means the sale is still open to higher and better offers and to court approval, so this isn't fully locked in yet. The numbers tell the story. Sleep Number listed assets somewhere between $500 million and $1 billion against liabilities between $1 billion and $10 billion. To keep the lights on during the process, the company expects to secure up to $260 million in what's known as debtor-in-possession financing, including up to $65 million in new money. Sleep Number's chief executive, Linda Finley, said the turnaround had made real progress, but in her words, the company's capital structure remains unsustainable. The company also filed a motion to reject the leases on 44 locations that were already closed, while saying it wants to keep as many profitable stores open as possible. So why does this matter to you? A name brand, vertically integrated retailer with more than 500 stores does not file for bankruptcy in a vacuum. The mattress category is consolidating, and this signals just how much pressure slow demand and high interest rates are putting on specialty sleep retail. The real lesson here is in the balance sheet. A credible turnaround plan still wasn't enough when the capital structure was upside down.
And there's a second layer to this story that hits the supply base directly. The bankruptcy petition exposed nearly $28.7 million in unpaid trade obligations to furniture and bedding suppliers. 11 home furnishings companies landed among Sleep Number's 30 largest unsecured creditors. Those 30 creditors together are owed about $67.2 million, which means these 11 industry suppliers alone account for roughly 43% of that top 30 total. The largest industry creditor is Leggett & Platt, owed just over $10.2 million, and its subsidiary Elite Comfort Solutions is owed another $6.2 million. After that, you have Ergomotion, Hometex, and Electropedic Manufacturing, each owed roughly $2.5 million. Then a group including Future Textiles, Springs Creative, Carpenter Company, Bernhardt Furniture, Future Foam, and Culp Home Fashions, each owed between about $600,000 and $1 million. As unsecured creditors, all of these suppliers stand behind the secured lenders when assets get distributed. For some context on the broader trouble, Sleep Number's net sales fell 16% in 2025 to $1.4 billion, with a net loss of $132 million, even after more than $185 million in annualized cost cuts. This is the part of a retail bankruptcy that ripples upstream. These suppliers extended trade credit, and they may recover very little of it. If you sell into large national accounts, take this as a reminder to keep a close eye on credit exposure and payment trends before a customer files, not after.
Let's shift to the broader retail picture because it's more resilient than you might expect. Retail sales rose for the 8th straight month in May, holding up despite high gas prices, tariffs, and the conflict in the Middle East. That's according to the CNBC and National Retail Federation Retail Monitor. Core retail sales rose about 0.4% month over month and just under 7% year over year. But here's the catch for our industry. Furniture and home furnishing stores lagged the broader trend. They were down about 0.1% month over month on a seasonally adjusted basis and up 3.35% year over year. That trailed standout categories like electronics and appliances, which were up more than 11% year over year, and clothing, which was up more than 10%. The takeaway is that consumers are still spending, but they're steering their dollars towards essentials and away from big-ticket home goods. A 3.35% annual gain in furniture sounds fine until you set it next to double-digit growth elsewhere. The National Retail Federation's chief executive, Matthew Shea, noted that fading tax refunds are pushing shoppers to stretch their budgets, and that squeezes discretionary furniture purchases first. So plan your promotions and your financing offers around a value-focused customer who is buying, just not splurging on the living room. That caution shows up clearly in industry sentiment, which just took a sharp turn. The latest Home Furnishing Sentiment Index showed confidence collapsing only 1 quarter after hitting record highs. The score for above-average yearly sales projections fell from an all-time high of 142 all the way down to 78, matching the gloomy outlook from the fourth quarter of last year. The current state of business score dropped to 44, the second lowest since the index launched in early 2025, and not a single respondent rated business as excellent. Expected consumer demand fell nearly 40 points to 69, the lowest reading on record.
What are people worried about? 82% named sluggish housing and volatile mortgage rates as their top concern. Oil and gas prices came in right behind at 81%. And concern about geopolitical conflict jumped to 61%, up from just 31% the previous quarter. Tariffs actually slipped to fourth place. Hiring plans cooled too, with the employment score falling from a recent high of 97 down to 88. Sentiment is a leading indicator, so this kind of reversal matters. If your peers are this cautious, expect tighter inventory bets and more conservative buying plans across the channel through the rest of the year. Now for some earnings and a couple of bright spots. Lovesac, a top 100 retailer, kept revenue essentially flat in its first quarter, while setting up for what Chief Executive Sean Nelson called its most prolific year of new product launches. Net sales came in at about $138 million, nearly even with last year. The net loss was about $11 million, close to the prior year. Results were pressured by the closing of its Best Buy shop-in-shop locations and a 1% drop in comparable sales, but that was offset by 14 net new showrooms. One interesting detail: the reclining seat is now part of 1 out of every 3 new sectional setups, and a new high-end sectional platform launches later this year. Lovesac is also starting domestic production of its sectional seat inserts this summer to cut cost volatility and reduce shipping exposure. For the full year, the company guided to net sales between $700 million and $740 million. In this environment, flat is a win, and that Made in America move is worth watching as a tariff and supply chain hedge that other operators may copy.
On the luxury side, RH beat both top and bottom line expectations in its first quarter, even as tariff-related sourcing shifts pushed roughly $45 million of revenue into future periods. Net revenue fell about 1.7% to just over $800 million, but that still topped the consensus estimate. The company actually raised its full-year revenue growth forecast, now in the range of 4.5% to 8%. RH is leaning into bespoke, made-to-order luxury with new offerings it calls RH Estates, RH Bespoke, and RH Couture Upholstery. The bigger signal here is that RH is managing tariffs by reshuffling its sourcing, and it's costing some near-term revenue while it catches up on fulfillment. It expects roughly $75 million to land in the second half as those balances normalize. The lesson for operators is that tariff strategy and product positioning are now tightly linked. Let's talk about the supply chain, because there's a real tug-of-war happening. Global container spot rates rose for a 6th straight week as carriers took advantage of an early peak season and lingering disruption from the war involving Iran. Drewry's World Container Index increased 3% to about $3,550 per 40-foot container. At the same time, there's diplomatic progress that could eventually bring rates down. U.S. and Iranian negotiators are reportedly working towards an agreement that could reopen the Strait of Hormuz, the waterway through which roughly 1/5 of the world's oil normally passes. According to CNBC reporting, a peace memorandum could be signed as early as this weekend in Geneva, though Iranian officials dispute that a final deal is done. Oil has already responded, with Brent crude retreating from levels above $90 per barrel that we saw earlier in the conflict. So two forces are pulling freight in opposite directions. Strong seasonal demand and carrier pricing discipline are holding rates up, while a possible Hormuz reopening may eventually ease fuel costs and surcharges. For importers, that means your landed costs stay elevated in the near term, even if the medium-term picture improves. My advice is don't bank on relief just yet. Analysts expect any normalization to take time, and carriers will want proof of sustained stability before they pull those war-related surcharges.
A few quick items to round things out. Inflation crossed 4%. The Consumer Price Index rose about 0.5% in May, putting the annual rate at 4.2%, the highest since April of 2023. Energy drove more than 60% of that spike, with gasoline up more than 40% year over year. Consumers are feeling it. In a new survey from EY Parthenon, nearly 2/3 of consumers said they believe a recession is likely, and 90% pointed to transportation and gas costs as their top near-term budget pressure. EY's Mark Chambers said this softening confidence is pushing shoppers toward, in his words, intentional spending, which signals that retailers need to lead with value. And one note on tariffs. Customs and Border Protection has indicated that the next phase of its tariff refund program will, at first, be limited only to importers who are actively pursuing litigation after the government appealed a ruling that required nationwide relief. That next phase is expected by the end of July. Related to that, the trade firm Mowry & Grimson warned that scammers are now targeting importers seeking tariff refunds, and at least one case sending a fake email that appeared to come from customs and even included real company and supplier details. So please, verify any refund communication before you respond to it. That's your briefing for today. If you found this useful, take a moment to subscribe so you never miss an update. We'll see you next time.